Welcome to TheoTrade. This is Don Kaufman here doing the Theo Night video for December 5th, 2016. All right, markets just closed a few minutes ago. The S&Ps once again trading to the upside. I mean, you have to stand back from this. So, last night we get the Italian referendum. Okay, the markets immediately reopen, sell off a little bit. We rally. It's really similar to what we saw during the presidential election. The market sold off, obviously rallied. I mean, how many times a year do we have to see this to get it, right? Brexit, we sold off, then we rallied over here. Well, the rally was a bit more contained and constrained, if you will. Nevertheless, you have to sit back and look at, if you will, is this real buying or is it shorts getting squeezed? And, really, you're looking at some up moves. The S&P, I don't necessarily think it does justice. By the way, we did not close at the highs of the trading session over here. Just a few points off the highs. Nevertheless, what kind of reeks to me of short covering is much more what you're seeing inside of the IWM, which is the Russell product out there, which almost felt like at a portion today, people were panicking. And in fact, you can even see some extremely large odd size trades in here. Nevertheless, okay, that's an argument, obviously, that's you can't necessarily win out there regarding, well, is it shorts covering, real buying? Either way, people are buying. The S&Ps are up some 12 points. The IWM, though, becoming, if anything, again, you got to zoom out to look at the IWM, a little frothy over here. So with this pretty phenomenal upside move, I wanted to find just a few real standouts, some parabolic upside moves that I thought would be much more appetizing to be able to put on contrarian bias trades. And that is, what's a product that explodes the most to the upside? When I say a contrarian bias trade is, hey, we're going to stand in the way of the freight train with defined risk. And there's really two primary products that come to mind. One I'm going to start with happens to be the XLE. This is the energy sector. All right, so XLE, the energy sector, fairly parabolic move to the upside. And again, on a percentage basis, you have to do this justice. So I'm going to zoom out for just a moment. This is a 9-month chart. Okay, bear with me as I come into a little longer time frame. I'm going to go a year to date, and then I'm going to turn on a percentage chart. So coming towards, the end of the year, I think showing prices percentage does a little bit more justice. So here we are right around the time of the presidential election. Ultimately, the XLE, which is the energy, it's up about 12% year to date, doubles the move inside of the last month. That's what I'm talking about with like a kind of a parabolic move. So you're looking at we were up 12%. Well, now we're up 25% year to date. So what a difference a few trading sessions can make. In this particular circumstance, it would make sense for maybe the XLE to come in towards the end of the year. Oil has also obviously been labeled a number of times over here as being fairly wild to the upside. Oil isn't necessarily the XLE. Remember, the XLE are the energy stocks themselves, the Exxon Mobils, the Chevrons out there. One of the trades that often comes to mind, though, in standing in the way of a freight train, and again, this is a freight train to the upside, I'll use things called in-out spreads. Those in-out spreads might be as easy as going out here, okay? And this is buying a 76 half put, okay? Going about $2 further out of the money, selling a 74 half put for right around $1 debit. Now, the trade is literally risk a buck to be able to make a buck, but we're going to exit the trade typically when there's about a 55% profit. So if you went out and bought the spread for exactly $1, what's a 55% profit? It's after you made, between 55, 60 cents, you would go ahead and exit the spread. The reason you might do just that trade is the probability of touching, for example, the 74 half strike. It's about 84%. Now that doesn't mean you're going to make the full amount if we go to 74 half, but there's an extremely high probability of touching that. There's almost a $4 expected move in the next 39 days. So that's trade number one over here. Another one that you got to look at, again, if you're a market technician over there, appreciate this. Dun, 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 Goldman Sachs. Okay, on a year-to-date basis, and you got to zoom in over here, year-to-date basis, this stock is roughly flat. okay, coming into the presidential election. I mean, literally, if you look back here to November 4th, the stock is actually down 0.4% on the year. It's now up, okay, 29%. So it's had a 30% move. All right. And again, this is Goldman Sachs year to date, 30% move based on what? Presidential election over here. I mean, did they figure out a way to cure cancer? No. Did they have any new products? No. But they did get one of their boys into the Treasury Department. Remember, one of the, of course, one of the former and major members of Goldman Sachs is now going to be running the Treasury. Apparently, that's extremely good for the stock. But you have to ask yourself, is this company really 30% better off than it was a few weeks ago? You don't have to necessarily answer it, but nevertheless, listen, this is not a big fundamental trade over here. It's just a contrarian stance, okay? In this contrarian stance, you do have to be a little bit careful. Goldman Sachs does have earnings coming out, so we're going to shorten up the duration of the trade. I'm probably going to look towards the January 6th expiration. Stock's trading 228 and change over here. So what I'm looking at doing with 32 days remaining, very, very small spread. Now, again, I'm just going to price this spread with you over here. So this is a $2.50 wide spread. You want to buy it for right around $1.25. Risk $1.25 to be able to make $1.25. Again, risk $1.25 to make $1.25. Now, don't get too cute. There's no reason to do a $5 wide spread. Just stick with a $2.50 wide spread for right around, again, that $1.25 debit over there. I'll bring it up once again. There's the 230, 227.5. It's an in-out spread. It's bearish. I think the trade has a decent probability. Okay, and you can look at the probability of touching, even the probability of touching all the way down to 220. There's still a 61% chance. Okay, so it gives this trade obviously a better lifespan. And again, we're looking at what? All the way up to almost a $13.50 expected move inside of the next 32 days. So think about these trades. Again, some food for thought. Short the XLE, but just using an in-out spread. Short Goldman Sachs, just using an in-out spread. Some nice contrarian plays for what has really been, an utterly insane market in terms of exploding to the upside over here on, hey, every time there's more negative news, that's okay. Buy them. Eventually the music stops over there. But in the meantime, if you're going to take those short positions, do it with defined risk. Thanks, everybody, for joining us here at TheoTrade. I'm Don Kaufman. Be in the TheoTrade chat room all throughout the course of this week. Have a great week. Bye-bye.